Right, good afternoon, and thank you for making it back after lunch. Clearly, some people are enjoying the fare at the Celtic Manor more than others. The graveyard slot is always the best to get, so I'm going to make the best to keep you focused here. I've been asked to speak on the funding gap, and by way of introduction, my name is Jim Irvin. I spent 20 years in banking before moving into fund management 6 years ago. Actually, interesting conversation with some of the people from West Yorkshire last night, where I spent 11 very happy years working for the Halifax Building Society. And I watched that organisation grow and develop from being a mutual into quite an aggressive bank. I would say I left there 10 years ago and take no blame. But I've been asked to talk about the funding gap and the investment opportunities that it creates. I'm going to explain, hopefully, first of all, what the funding gap is. Try to, just a simple lesson on how the gap was created, what it is. Talk about the investment opportunities that are created from it, and how, if at all, you think it makes logic for your own investment portfolios. So, what is the funding gap? Well, quite simply, if I'm not sure, I haven't looked in Wikipedia, but if it was on Wikipedia, it would say the gap that the banks left behind. What's happened to the banking industry? Without giving you an A to Z, their funding has got far more expensive than it was pre-crisis, for a variety of reasons. If you take someone like Royal Bank of Scotland by way of example, their 5-year unsecured senior lending at the moment is maybe trading at something like a couple of hundred basis points over swap rates. That's in from its wides of maybe 400 at a point. Pre-crisis, those numbers were more like 20 basis points. So just by one way of example, if that bank needs to borrow, it needs to pay a whole lot more for it. Why is that? Well, there's a whole range of reasons, many of which are well documented and I won't go into today. But some of the bigger issues are the capital charges that the banks are facing. Companies like Deutsche Bank would have existed on a 5% ROE for a bank in the last 20 years. That's not smart business. The fact that they are getting greater and greater regulation upon them means that they are more focused on the extent of their capital and the returns that they have to create from it. There's new regulations in place, whether it's from stress testing, whether it's political landscape, the pressure of de-risking the banks and potentially splitting investment banking activities from retail banking activities. All of that is done with one, or all of that pressure is brought with one main focus in mind, and that is to protect the consumer. So Mrs. Miggins, who invests in we manage money for that's in your pension funds, and also puts money with banks. Well, Mrs. Miggins has got a right not to have to go and queue outside the Northern Rock and panic about her funding. And that's what's behind the legislative push, the political pressure, the increase in capital charges, more expensive funding, and in turn that means the banks are lending far less today than they were pre-crisis. And if they are lending, they're demanding a whole lot more return for it. And in this session today, I'm going to give you some real-life examples of large-scale projects that banks did finance before. I'll show you the sorts of levels that they did it at, and hopefully create you the opportunity to say, does that make sense for my pension fund to start thinking about replacing what the banks used to do, but doing it on a far smarter basis, doing it for far higher returns, for far less risk. And that's what I'm trying to leave you with today. But not only me, I've gone out there and I've spoken to some market participants.
The funding gap is effectively the gap between what is needed for lending to the capital sectors of the economy and what is available in terms of lending. So what was available in the capital sectors of the economy was largely from banks. Yeah. Banks have backed off a lot in terms of what they're willing to lend to, what they're able to lend to for a variety of reasons. But the demand for capital expenditure in the economy has not reduced dramatically. Yeah. So that gap between what's available for funding and what is necessary is growing. Yeah. Is grown enormously over the past few years. And that's really what we mean by the funding gap. But by any measure, the amount of deleveraging that banks have to do, and consequently the amount of funding that somebody else has to do, is staggering, well in excess of 2 trillion euros.
The problem really is the debt funding gap is really that the debt that is currently in place is very difficult to be replaced with new debt. And that is essentially what the debt funding gap is about. It's a bit unclear what the final impact is, but the IMF actually came out with some good estimates just before the summer. Their estimates are between 2 and 3 trillion of deleveraging for European banks, and that's on the back of the stress testing. So quite big numbers. This is a big problem. It's not just real estate. We understand it's throughout the economy, and it does impact economic growth and the outlook for everybody, really.
The impacts of the funding gap won't be uniform. There'll be certain sectors that will get impacted more than others. It's difficult to generalise, but you can certainly say that sectors that require higher capital usage are certainly, given the constraints on capital of banks' balance sheets, are going to be areas that will get disproportionately impacted.
The larger areas where there is really a critical shortage of funding are probably commercial real estate for one thing, project finance, infrastructure. Those are probably the 3 areas.
In particular, the very different repercussions for borrowers and for investors. From a borrower's perspective, credit is getting more scarce and it's getting more expensive. So if they're to take certain types of credit, they're going to have to pay an awful lot more at lower risk points. From an investor's perspective, the repercussions are very different. There are opportunities now to access credit and be much more generously paid than the similar credit would have provided in the past.
That's the banking sector. It's, as a fear of repeating myself, it's less easy to get credit. Therefore, if you're prepared to become effectively a potential provider of credit through your pension funds, you're going to be able to grab enormous opportunities. And let me go one step further. That was the banks. Now, why did the banks do a lot of things that they did? I'll show you some real life examples in a minute. But the banks were very dependent on the capital markets to ultimately take them out of the risk that they put themselves into. So you take someone like a Royal Bank of Scotland, they would go out and they'd put $1 billion or a couple of billion on the table to finance something like Canary Wharf, a very landmark development in the City of London. They did not want to be lending their money for 25 years, but they had to put a structure together that enabled that to happen, to then create the buildings, find the tenants, and ultimately what they did would be using the capital markets to restructure the loan into something like and forgive me if it's a little jargon, into something like a commercial mortgage securitization. So they'd arrange a bond, the payback of the bond, dependent on the payment of the leases in the buildings. And that worked very successfully, and the banks, or Royal Bank of Scotland, would build this building, it would create the structure, it would get fees for organising the loan, it would get fees for organising the capital market transaction, its salespeople would sell it all down, and the banking industry was dependent on the capital markets for what I call their exit strategy. 2 problems now. You've got the banks who are less willing to lend in the first place, and that's exacerbated by the fact that the capital markets were so broken for a period that they did not have their exit strategy. So even if they could borrow at a reasonable level, even if they did have reasonable capital charges, they're still dependent on a takeout on the other side. And we'll touch on some real examples in a minute. What you're looking at here in this slide is, I was sat on the 13th of August 2007. There was a commercial paper, a Canadian commercial paper business, was not able to refinance its 30-day paper. It was called Coventry, if you want to go Google it. That sent shockwaves through my head. I also spent 20 years, by the way, in the structured finance markets. What I knew at that point was that if the liquidity was being withdrawn, we had a massive problem in our hand. And this graph here shows you one part of that market. The US money funds, and some of the pension funds, in maybe not in this room, but certainly in this building today, some money funds were impacted in 07, 08, 09 because the value of the cash funds dropped dramatically because ultimately they were investing in things backed by asset-backed securities or properties such as Canary Wharf. Good quality assets, but the investors didn't like the fact that there was a liquidity crisis. But what you see here is at its peak, the secured commercial paper market in the US fell from 1.2 trillion to 400 billion, just less today. So 800 billion of financing that wasn't provided by the banks was withdrawn from the market over the same period. So that exacerbates the problem of and this funding gap. The providers of finance are finding it harder to do it. The investors in some of that finance backed away at the same time. And it's real. You know, who does it affect? I've already touched on Canary Wharf. But looking at that building down the bottom left, you may recognise it as Moore Place, London. I'll talk about that in a minute. Companies like Birdseye, Weetabix, they all borrow through the levered loan market. Many of these loans ended up in structures financed by the capital markets. Alliance Boots, the largest leveraged buyout in history, close to 10 billion, financed by the same marketplace. And a lot of this was done, infrastructure debt lending done for the air traffic. A lot of that stuff it is provided by the banks because they thought they had exit strategies to get out of. There are two banks you may or may not have heard of. DEPFA, D-E-P-F-A, Dexia, D-E-X-I-A, a Belgian and a German bank, two of the largest banks who provided debt finance to infrastructure. Between them, 80 billion on their balance sheets. They're now effectively bad banks in runoff. Why did they get into it? Because they had a capital markets business that was getting paid fees to get involved. It was lending their balance sheet for 20, 25 years, not what their shareholders wanted them to do. But again, it's impacted the demand for infrastructure debt, leaving another opportunity. So what opportunity does it bring? The banks aren't going to disappear. The banks will still want to lend. The banks will still want to get their fees for creating structures. The banks will provide and create new investment partners. The phrase "new normal" was used in one of the presentations this morning. That's exactly what we're trying for here. We're in the process towards finding a new normal, and many of you in the room can help shape that if you determine that there's a logic in having some of these assets in your investment portfolios. What sort of assets? Well, loans to medium and large sized companies, some of which the types I've referred to already. We've gone through the shift in the bank capacity. You can do that through secured bank loans. And note that word secured. Even if your lending goes wrong, you end up with security. Defaults are something like 2% per annum. Loans in commercial property. You can lend directly or you can invest straight into structure. That number there is Europe, 2.5 trillion euros currently financed majorly by banks. A huge part of that needs refinanced by the end of 2015. A lot of the refinancing will occur because it's in the bank's interest to extend the financing. But anyone who thinks that this crisis will be beyond us in a year or two, just dig a little bit deeper and realise that what I call past the parcel of risk is going to take years to end. But you can, if you choose, be part of the solution. Infrastructure projects I've touched on. You do it through infrastructure debt. Secured credit. I don't call our business structured products anymore because it seems tainted. Secured credit is a far better explanation and describer of what the business is. You're lending in a credit environment on a secured basis. And read through the headlines. In Europe, there has been next to nothing in the way of defaults in the asset-backed market. But again, it was financed by the banks. The vehicles which took it out are no longer there. And there is a massive opportunity to replace this over the long term. So what sort of, excuse me, yeah. Looking a little bit closer, if one were to consider the investment horizon, let's look at the sorts of assets. So if you were lending on secured credit, it's going to be an asset-backed, it's going to be in secured high-yield bonds. More and more of the levered loan market is being refinanced in the high-yield market. Why? There are archaic rules that says listed securities such as high-yield bonds are suitable for retail. And we, Henderson and others, can sell through our retail networks, through our platforms, high-yield bonds because they are listed on an exchange, but they are unsecured. We cannot sell through to retail in any meaningful fashion levered loans. Levered loans rank higher than secured high-yield bonds. They are a safer instrument than unsecured high yield, but because of certain usage rules, we cannot sell them to retail. So more and more of that market has been refinanced into the high-yield bond market, listed securities, but the security is going with it. You're senior in the lending structure as well. In the environment we're in, all of these assets, the vast majority of them, excuse me, are floating rates in their nature. So you're not taking duration risk, but you may be taking 5, 10, 15-year loan or investment, but on a floating rate environment. So to the extent that you're nervous that interest rates might rise, you're locking in, at this point, a fabulous swap spread over the funding rates. It's not an inflation hedge, but it's certainly a hedge against rising rates. And these sort of investments are not typically found in pension fund portfolios today. Why is that? It's not because they don't fit. It's because the previous providers of the exit strategy for the banks paid far too aggressively for those assets and drove the spreads of them way down. They wouldn't have made any sense from an investment perspective. They make a ton of sense from an investment perspective, given the returns that are available today. Okay, Moore Place in London, just to make this a bit more real. So if any of you are aware of the development, it's just south of Tower Bridge. I think there's 6 buildings, fabulous buildings, 100% occupancy, 20-year leases typically from the occupants. Occupants such as PwC, Ernst & Young, and some of the largest legal firms. Great place. Financed in 2006 by Royal Bank of Scotland. Royal Bank of Scotland lent against the development of that business at a loan to value of close to 80%. They got a spread over swaps of less than 1%. Today, if that building or buildings of its type are being created, you can lend to it closer to 60% loan to value, but with a swap spread of close to 3.5%. And you'll be locking that spread in on a floating rate basis for 5, 10, 15 years. Again, RBS were prepared to be aggressive because they had an exit strategy into securitization. Taminco, not a name that I personally am so familiar with, but our levered loan people invest in this. So here's a company who borrowed. They're a huge global chemical company who borrowed pre-crisis. And down the left-hand side, you'll see the rates that they were paying pre-crisis. So, you know, they're leveraged. There was 25% equity, so they're levered 4 times, paying a spread at that point of about LIBOR plus 3%. Today, well, in fact, earlier this year, this company did refinance. It wanted to extend the maturity profile of its balance sheet, and it paid effectively double the spread for a third less leverage. And that in itself encapsulates the fact that when I talk about this opportunity, I try to summarize it by saying it's doing what the banks used to do, but doing it on a far better, far more sensible, and a far better risk-reward basis than they ever did. The banks were driven by the desire in the main for fee income to turn these things around quickly. Just, you know, revenues in that company, $1 trillion last year alone. So, how do you capture it? Let me just let you hear some thoughts from those people again.
That also means that perhaps they'll have to leave market share to others that are not banks. And of course, non-bank lenders have started to pick up some of that activity because the terms and conditions of the loans are very attractive for lenders at the moment because the demand is quite high and the supply is actually coming down because banks are not doing a lot of lending at the moment and they're finding it very difficult with the new regulations that are coming in to do so. The terms and conditions at the moment are historically incredibly attractive for lenders. Now, of course, borrowers are finding it difficult to deal with that, but that's that's the other side of the equation.
That means that they're going to be far more cautious about that long-term lending, those 15, 20 plus loans that banks used to aggressively provide to maybe housing associations on infrastructure projects, for example. That is going to be more difficult for them to do. That will create opportunities for institutional providers of debt who are happy to have and may actually prefer to have those longer term assets as part of their balance sheets. I think in summary, we will start to move more towards that which we see in the US, where historically you've had a much more broader provision of finance to corporations, to real estate borrowers, from both banks and pension funds and insurance companies and other credit opportunity and private equity funds. That will take time, but we do believe that is what you're going to start to increasingly see, and that will create some very interesting opportunities for those new investors that are prepared to do the work to understand these new emerging asset classes. You're going to see this perfect combination of higher return at lower risk. If we look at the secured loan market, for example, we've seen refinancings in recent times where you've had the leverage of the borrower some 30 to 50% lower than pre-crisis, but the returns equally some 30 to 50% higher.
Basically, every penny of lending, every penny of capital in the economy was really going through banks. And if that goes away, obviously, banks are no longer able to do that. Banks have to cut back, and so that other people have to step into the breach. But there is no doubt that within the next year or two, hopefully, we will be out of the recession. At that point, there'll be a great need for capital across the economy, in the corporate sector as well as in the small business sector, and in commercial building as well. So all these things will be crying out for capital. And I see an enormous potential for pension funds in particular to be involved in this kind of sector.
Krishna, who was talking there, just to put a little thing in perspective, spent 10 years at Lehman Brothers. Then went into fund management. He's now back at Royal Bank of Scotland. Hans Vrijsen, the guy with the glasses, he was many years at Barclays. So these are people who've worked at the sharp end of the creation of that recycling that was going out elsewhere. And these are people who are becoming real spokesmen for the opportunity that's out there. They're not doing any sales job anymore. They are very intellectual, very well informed, and I'll be happy to put anyone in touch with them if you so wish. Let's look at the returns. One eye on the clock, given we started late. But what sort of returns might you get from doing this? Well, the red line here is a summary of what European equities have done in the last 7 years. Had you been invested in what we're describing here as a liquid portfolio, I'll come on in a second. There's really two strategies that you would want to consider, whether you've got a liquid strategy or a longer dated illiquid strategy. A liquid strategy here that we're showing has got returns which have been on average far exceeding that was available in European equities for far less in the way of risk. That's a volatility measure we're looking at here. So you're taking higher volatility in corporate bond lending, but you're getting far greater return. You've got far less volatility in the European equity market, but far greater return. And when we've been talking to some of our clients about where might this fit for me, it's for pension funds themselves to determine whether it comes out of diversified growth or bond replacement or its alternative, whatever. But the fact of the matter is that if you're looking for long-term strategic opportunities that are not going to go away anytime soon because of the enormity of this gap, I think that funds are going to be very much a significant part of the new normal when we look back in this in 10 years' time. So the returns available. On average, we'd say that 6% to 8% is very achievable, and those are using current swap and LIBOR rates today. The more liquid you go, then you'll see something like asset-backed securities paying a little bit less because it's daily tradable. But we are seeing a number of certainly our fund clients are looking to that as a strategy. If you look to the far right of the page, then obviously if you're lending against premises such as More London or Canary Wharf, that's not an asset you're going to sell in an afternoon. That is, you're committing yourselves there to long-term lending, but that's exactly why we think that it makes logic for the true lenders in those sort of long-duration product as pension funds. There was a session this morning, someone asked a question about are the actuaries doing their jobs? How can you be matching assets to liabilities? Well, if you can be getting longer dated assets with the sort of low risk profile that these things offer in today's environment, I for one think it's got to make some sense. Where in your portfolio, for you to decide. A couple of thoughts to leave you with. This is not unsecured lending. You can dictate the duration, you will get security, but do remember the liquidity. So you could have something that's getting you daily, weekly, monthly liquidity, or you've got something that's far, far longer, and the duration will match. Segregated or pooled, I'm sure many of my competitors, I know that many of my competitors are looking at this as well. I think there's a massive opportunity for you as investors, but there's also a big opportunity, to be blunt, for the fund management community to provide these solutions, and I think there's an awful lot of space there for everyone to work together and get involved. And it's not a UK opportunity, it's not a European thing, it's global. The US is sorting itself far quicker than we have in Europe. It's taken far more aggressive steps, but they're still pretty much in the same boat. The banking communities in the exact same state of health as it is here. So, I didn't put the strat line here, but I would say if you do choose to get involved, and I am repeating myself, but I do like this line, you'd be doing what the banks used to do, but doing it far smarter for far greater return. And I hope I've left 5 minutes or so if there's any questions. I ran through that a little bit quicker than I would normally, given that we started 10 minutes late. I hope it resonates. If there are questions, I'll take them now, and if not, then feel free to approach me or my colleagues afterwards. We've got a microphone, please. Plant that question. There are, if you take prime residential mortgages, for example, so the average mortgage that people in this room would have taken through the Lloyds, the Royal Bank of Scotland, the cumulative defaults in the UK in 5 years, cumulative through the crisis, is zero. Those assets are trading today at LIBOR plus 150 to 200 basis points. Pre-crisis, they were trading at LIBOR plus 5. If you go to what we call in the UK non-conforming, doesn't mean subprime, it means that you are perhaps self-employed. You may not have 3 years accounts, but you're borrowing 50% of the value of your property. You're having to pay a higher borrowing rate because of that. Cumulative defaults there are 1-2%. They are tiny. The US got all the headlines. I've often said that the US sneezes, we catch a cold. And we're catching a cold through guilt by association. But asset-backed in the main, if I read across the piece in Europe, other than, forgive me for the jargon, CDOs of asset-backed, so when you create a bond that takes lots of other asset-backs and you put too much leverage in it, that's the only place that there's really been a problem. Is that a question here? Is there a microphone there, sorry? You don't? Oh, sorry.
Just a very simple thought. Could you just clarify a little bit more the difference between asset-backed and secured loans, because they sound both asset-backed and both secured. I'm not sure. I'm just wondering if there's any index-linked opportunities in this sort of space too.
Yeah. I got the second bit. So explain the difference between asset-backed and what? Did you?
Secured loans.
Okay. Okay. So secured loans. So take the case of Taminco that we saw here. So that's or Weetabix or McAlpine. So any large, medium to large size company is going and it's borrowing, but a secured loan is actually taking first charge on its assets when in the event, I mean, you might end up with a bunch of tractors from McAlpine, but you have security on the balance sheet. You're first to be paid. You're senior and you're secured. An asset-backed security, so you could take credit cards, you could take mortgages, you could take the leases on that building I showed you, the Ernst & Young and PwC, so and what's called the receivables, so that they are obligated to pay creates a pot of cash. And from that pot of cash, you create a bond, and you will top slice, you will set up a structure, and you can choose various risk parts to get involved in. So an asset-backed security is a security backed by assets. A secured loan is a loan to a company to which you retain security rights and can dictate severe covenants to those companies against the loan, within the loan documentation. So inflation-linked, not as easy a solution, I'm afraid, but perhaps the fact that they are mainly floating rates in their nature gives protection against rising rates, not a natural or a perfect inflation hedge, but there have been, to the best of my knowledge, next to nothing. And I bought my first mortgage-backed security in 1991. Maybe one or two transactions were ever issued with index linking. Any other questions? No, well, as I say, I'm happy to be approached later or at any time through my colleagues. Thank you for skipping your pudding and getting back on time. And it's been a pleasure to have the opportunity. Thank you.